Welcome back. There's a look at the pre-market action on shares of Nvidia, up nearly 6% in the pre-market after the chip-making giant exceeded expectations with its earnings and revenue as data center sales jumped 73%. Our next guest says artificial intelligence players could continue to see upside. However, she adds that this is a stock picker's market. For more on what tech names could be the winners in this environment, we're joined by Schleif, Chief Market Strategist at BMO Private Wealth. Carol, thanks a lot for joining us. What's your take on the Nvidia numbers? The stock looks set to move significantly higher today.
Well, and it does seem like they're speaking for the industry, if you will, and reassuring some investors as investors look towards what lies ahead, especially in light of the shifting tariff news that we had overnight and a lot of other things going on there. But I think that the private sector spend, whether or not we have CHIPS Act money that gets pulled back from the prior administration and things like that, the data center spending that's going on, the private sector spending that's going on to compete in this next phase of technological rollout, if you will, should continue.
Well, you mentioned the tariff news. What is your take, by the way, on the market's reaction, which appears to be positive, to the court ruling yesterday, effectively blocking, at least for now, the U.S. tariffs that the White House has imposed on many trade partners?
Yeah, the interesting thing is in the futures market, the initial reaction was extremely exuberant. And as people have had a chance to think through and see the administration's reaction and think through the potential implications in terms of this is a pivot for them, the administration clearly believes very strongly in tariffs as policy and to fulfill a number of different objectives that they have. And so as markets have rethought it, you've seen the futures come down pretty dramatically, things level off, because I think investors are starting to realize that this actually potentially introduces more, not less, uncertainty as things get sorted through. Companies try to decide, and countries try to decide, do we negotiate? Do we hold back to let it play out in the courts? And then that forces the Fed even more to stand back on the sidelines. So it introduces the potential for more uncertainty in the short run, but it also shows you that the markets are desperately looking for any ability to move on from the tariff issues and focus on other things. And so that initial exuberance was pretty understandable.
Does move on from the tariff issue mean see these tariffs steeply reduced or eliminated?
And not necessarily. It just means have the outlines formed so companies know how to act. Because initially, when they were first put out there, the potential range of outcomes was so broad, and it's tough if you're a company. Investors can shift to the news a lot easier than a company can, because you're trying to decide, where am I going to manufacture? Am I going to shift it out of China? And well, take Apple's case, shift it out of China, move it to India. And then you're told, well, I don't want it in India either. It needs to be here. And so you're trying to decide where you're going to put plant, where you're going to put people, where you're going to put equipment. And in the near term, if you're a retailer or any sort of consumer goods seller, you're worried about, am I going to have empty shelves come back to school season or the holiday season? And so you've seen a lot of activity move even in the pause in there. And so for investors, and particularly for companies and for intermediate longer term fundamentals, it means getting some sort of rationale around, okay, we're going to have X% tariffs on this particular product or this particular line or this set of goods coming from here, or we're going to have this. You just need a bit more clarity so companies can move and plan, because they haven't been static in the background. They're trying their best to scenario plan their way through it. So once they get some sort of clarity, then they can move, because the underlying economy has stayed pretty solid.
How relevant to the markets is the U.S. tax legislation now moving from the House of Representatives to the Senate? That's the so-called big, beautiful bill. Lots and lots of outside observers are very concerned about deficit and debt levels in the United States. Should this be a concern to stock market investors?
It should be a concern to stock market investors. It's clearly a concern to bond market investors. We wrote a weekly piece, and I wrote last week's all about how the bond market is watching this very closely. And ultimately, the bond market may have a bigger vote than either house in Congress does, because clearly the administration watches the bond market too, as they should, because it's very concerning for future generations in particular that the potential to add to the debt. And the bill as it passed out of the House, depending on how you look at the scoring, adds trillions to the deficit over the next decade or so. And the budget that the Senate has set itself is even bigger. And so bond markets will watch that, and it does trickle through pretty immediately into stock market performance as well. So we all should be watching that progress as it goes through. Now, that said, there are stimulative parts to that in terms of tax advantages for businesses to put plant and equipment and manufacturing and do research in the United States. And those components of the bill could be stimulative. So markets in the short run like the stimulative portion of that, but we have to pay the bill sooner or later.
Carol, thank you as always for your insight. That's
Thank
Carol
you.
Schleif, Chief Market Strategist at BMO Private Wealth. Coming up,